Hey everybody, welcome back to Dividend Stockpile. So today I'm going to be talking about my entire REIT portfolio, so real estate investment trusts. If you follow the channel for any length of time, you know that I'm a huge fan of real estate investments. I have 12 REITs in my portfolio, plus one REIT ETF that I wanted to share with you today. Now these are my choices for my portfolio. It's not financial advice, please do your own research, but I've identified what I feel are 12 very strong companies with stable cash flows, stable dividends, and growing earnings. So I'm going to be talking about that. I'm also going to be talking about why REITs now. As you know, over the last couple of years, REITs have not done so great. With the higher interest rates and everything else in the economy, it's really affected them a lot. But these 12, I feel, have what it takes to move forward in the REIT space as interest rates come down and as the market changes over time from your high growth to maybe more conservative names. So again, I'm going to talk about why REITs now, the 12 REITs in my portfolio, and talk about the one REIT ETF I have. So let's get started. Alright, so as I mentioned, I've been a fan of REITs for a very long time. But why REITs now? Well, the main reason is because the expectation of interest rates going down over the next few months is very high. According to Google, they say the Federal Reserve is expected to cut their rates starting in September 2025, which is only a couple weeks away. So this is highly anticipated and almost a certainty, according to the financial markets, that there's going to be at least a 25 basis point reduction in the interest rates that the Fed sets. This won't directly cause REITs to go up, but it does provide a tailwind that's going to allow them to grow over time. A lot of REITs use debt to grow their business. If they're able to pay less on interest on their debts, they're going to be able to expand faster and be more profitable. This is the first rate decrease they expected for 2025, but the expectations is that they're going to be significantly more over the rest of 2025 and into 2026. So all these REITs that have been struggling over the last couple of years of high interest rates finally have a chance to make some money and to be more profitable in the years ahead. And that's why I think it's a great time to be a real estate investor. So with that, I'm going to go through each of my 12 different REITs, as well as my one REIT ETF, and talk about why I picked what they are, what they look like, what they do, and some of the metrics associated with them. So let's get going. Now I'm using allreits.com for this analysis. Allreits.com is the best real estate investment trust website you can go to research different investments, both in the real estate and regular investment space. Allreits is free to use, but if you want to use their premium services, I do have an affiliate link. There's no cost to you, and I will get a small commission. No obligation, of course. Okay, so the first up is Agree Realty, ticker ADC. The way that Allreits scores their REITs is by 5 different categories. So debt, year since IPO, payout ratio, adjusted funds from operations growth, dividend growth, and adjusted FFO by share growth. And so when they equal all those up, the ones that are the best get a score of 100, and it goes down as low as 0, depending on their score. So Agree Realty gets a perfect 100. They've been in business for 31 years, and their main focus is retail properties. Looking down a little bit more, valuation looks like they're fairly valued at this time. It's a price to AFFO, which is very similar to price to earnings, but for REITs, it's a 5-year average is 17.2, and right now it's 17.1, so I'd say fairly valued right now. The dividends have been growing over time. The current yield is 4.28%, so it's very solid. And it looks like they might have cut, but what happened is it went from a quarterly distribution to a monthly distribution. So this is a monthly payer. So even though it looks like it's cut, they're producing the dividend payout each month, so it's actually the same amount. They have a 32-year history of paying dividends, and their forward dividend growth is about 2.4% according to all REITs. And their 3-year and 5-year are 3.1 and 4.3 respectively. Now, that's not the greatest, but you have to consider that they're already providing a very high starting yield. Their payout ratio is very solid at 73.3%, which gives them a lot of upside potential to increase the dividend over time. Looking at the yield, it looks like it's right on track for being fairly valued. The 5-year average is 4.3, and it's at 4.28 right now. So again, fully valued on this one in particular. Scrolling down a little bit more, you can see some of the financials, and this is what I love all REITs for, is it puts us all in chart format. AFFO growing over time. AFFO per share is growing over time as well. So that's another thing to really consider, because when you're investing in REITs, one way they raise money to buy more properties is to issue more shares. And so that's perfectly fine as long as their AFFO per share is growing over time. If they're issuing more shares, but then their AFFO is not growing, that means they're not doing a very good job with the new shares that they're releasing. So again, it's rising over time in line with their dividend increases, so it's perfect right now for that. Debt to assets is relatively low. Their debt coverage is perfectly good, and their occupancy is top tier at 99.6% occupancy. That is unbelievable and pretty incredible for a REIT. Their 5-year average is 99.7, so they've been doing this for a long time, and they're doing really well at keeping their tenants. Their largest tenant is only 6% of their portfolio, and that is Walmart. And again, I have no concerns with Walmart whatsoever. And the average life of the lease that they have is 8 years. So they've still got very stable tenants. They're going to be paying them over time and increasing the rent on a yearly basis. All right, so that's Agri Realty. Again, one of my very favorite real estate investment trusts. Next up, we have Alexandria, which is ticker ARE, and they're a life sciences REIT. So what they do is they own the real estate for life sciences, technology, and ag tech campuses, and what they call AAA innovation cluster locations. So these are high in-demand areas around university and other healthcare-focused areas. And what they do is they lease it out to long-term tenants like drug developers and so on. So it's not a perfect score. They did get a 90 out of 100. And two of the things that they were concerned with, all REITs is concerned with, is the adjusted FFO growth and the adjusted FFO per share growth. So we'll look at that as well. This company has been around for 28 years, so it definitely has a lot of history. Now this one in particular is very well undervalued. Now, the entire healthcare space has been undervalued for quite some time, but this is not a company that produces the drugs or produces the medicine. They are just leasing the properties to these pharmaceuticals and life sciences companies that are doing the research and developing the drugs. So they're a little bit more insulated from the ups and downs of the pharma market, but they do get lumped into that space of healthcare, and that's probably one reason why the values have gone down. Current price to AFFO is 8.7 times, and their average for the last 5 years is 12.4, so very significantly undervalued. Looking at the yield, it's 6.55% right now, which is very strong. They had to cut during the Great Recession back in 2009, but since then they've been increasing their dividend regularly over time. Their 5-year dividend CAGR is a little over 3.5%, so if you mirror that up with a 6.55 current yield, that's a pretty good combination. And their payout ratio is only 56%, which is, again, their 5-year average as well. So they have plenty of room to expand the dividend over time. Looking at valuation again, the current yield is 6.55, with their average being 4.93. So it's significantly undervalued both on a yield basis as well as an AFFO basis. Scrolling down to some of their financials, you've seen a slowdown in their AFFO growth over the last year or so, but their long-term track record is amazing. Their AFFO per share has been increasing, and their debt to assets has been steady over time with plenty of interest coverage at 10.8 times. Occupancy is a little bit lower than Agri at 90.8%, but you have to think about the size of these tenants. You're not going to have 1,000 different tenants like you do for Agri Realty. It's going to be more limited. And their biggest tenant is only 5.5% of the portfolio, and that's Bristol Myers Squibb. And they have a 7.4-year average lease term. All right, moving on to the next REIT. So that was Alexandria. Now we're moving on to American Tower, ticker AMT. And this is best known for the cell phone towers. So they lease the land and put up towers, and then each of the cell phone companies and cable companies use their towers to transmit cell phone signals. And so they get money from all the major ones. So it's getting an 83 out of 100 from all REITs. The issues are the debt level, as well as the AFFO growth and AFFO growth per share. They've been around for 27 years, though, so a very well-established business. Looking at valuation, it looks like it's slightly undervalued at 19.1 times AFFO, with an average of being 20.5 over time. Yield is 3.44, and as you see, their dividend has been growing for the last 10 years straight, and they've been paying for 15 years now. Looking at their forward dividend growth, all REITs is expecting a 4.9% average increase, which is right in line with their 3-year average of 5.2 and a little bit under their 5-year CAGR of 7%. Payout ratio is at 66%, still very solid. And you can see they're slightly undervalued on a yield basis, 3.44 right now, with a 5-year average of 3.07. Looking at their financials, you can see that generally speaking, the AFFO is growing, but it does have a little tick down this year. So it looks like AFFO growth might be slowing. Debt to assets, while it shows it as red, is still pretty reasonable at 58%. What they are concerned with is the largest tenant is T-Mobile. Remember, there's only so many cell phone companies in the world, but 16% of their revenue of their tenant is T-Mobile. Okay, moving on to our next REIT is Apple Hospitality, ticker APLE. Now, this is a hotel REIT. What they focus is on room-focused hotels. So you're not going to have the big conference centers, you're not going to have these luxury resorts, but what you're going to have is quality rooms, a simple layout in the areas that matter most to business travelers and families, and they're going to be really good at what they do. So this one has a little bit of a lower score from all REITs, and that's mainly because back in the pandemic they had some issues. So their dividend growth and their AFFO growth have been slowed down because of that. As you remember, hotels were completely closed during the pandemic, so it definitely set them back a little bit. They have been around for 10 years though, and the current price to AFFO is lower than the 5-year average. This might be a good time to get in, and they do pay at 7.49% yield right now. As you see, back in the pandemic, they had to cut their dividend. They slowly raised it back, and now they're raising it even more. They also pay a special dividend over the last couple of years, so that's an added bonus. Looking at their payout ratio is solid at 61%. All right, their dividend growth, because they have the special annual payouts, it looks like it went down, but over the last 3 years, their average is 20.2%. So that's what I really focus on. And the reason for that is they're trying to get back to where they were before the pandemic. Looking at the current yield is a good value right now at 7.49%, with the 5-year average being 6.1%. Looking at some of the financials, again, because it's a hotel REIT, they really did struggle in 2020, as you can see, but since then they have rebounded and their debts are very low. Occupancy is 78%, but you got to remember these are the individual rooms of the hotel, so generally speaking they're not going to be at 100% occupancy, even though their tenants do cover all their properties that are out there. Okay, moving on, not to take too long, is EastGroup Properties, ticker EGP, and this is an industrial REIT. They have the big warehouses that all the major e-commerce businesses ship from, so they emphasize on locations in Florida, Texas, Arizona, California, and North Carolina. I'm down here in Florida, so I've seen some of these just myself. They get a 100 score from all REITs, so it's looking really good. One of my favorites as well. The current price to FFO is lower than their 5-year average, so it looks like a good value right now. And their current yield is 3.73%. I see they have a long history of dividend increases, so I feel very confident in this particular company. All right, their forward dividend growth is expected to be over 10%, which is very solid, and their 3-year and 5-year is very solid as well. It's 9.7 and 15%. The payout ratio is 72%, which is still very reasonable. And the yield shows that they're slightly undervalued right now compared to their 5-year historical average. Looking at their financials is what you want to see. FFO is growing, FFO per share is growing, debt to assets is going down, occupancy is very strong. Their largest tenant is only 1.6%, which is Amazon, which I have no problems with whatsoever. All right, moving on to our next REIT is Equinix, and this is a data center REIT. And so they score 93 out of 100 from all REITs. The only thing they're missing is the debt level, and so we'll talk about that in a second. Price to FFO is 20.7, lower than their 5-year average of 24, so it looks like Equinix is a good value right now. They've been paying their dividend for many years now. It says 8-year dividend growth streak and 12-year dividend history, but it's only paying 2.46%. This is generally what you'll see for the data center REITs. The yields are kind of on the low side. But their dividend growth makes up for 10.1% over the next year, and 14.9 and 13% over the last 3 and 5 years. Payout ratio is very low at 51%, so they have plenty of room to increase. And it looks like their valuation is good as well when it comes to yield. Right now they're paying 2.46%, and their average is 1.96, so you get a little bit of a value there. AFFO per share, up and to the right, just like you want to see it. Debts are a little high, but they do have interest coverage ratio of 8.5 times, so they have plenty of money to pay the interest. And their occupancy rate is on the lower side at 78%. But their largest tenant is only 2.6% of their holdings, and it is a cloud-based company. All right, so next up we have Invitation Homes, ticker INVH, and this is another one of my really favorite ones. What they do is they purchase single-family homes throughout the United States, specifically on the West Coast and in Florida, and then they rent them out to individuals and families. What I like about them is they target higher-end homes. They have very nice features, and so you get a really good rental rate on that. They've been around for about 8 years now, and they have a 95 out of 100 from all REITs. And again, the main reason for that is the IPO was only 8 years ago, so they get a little bit of mark for that. But generally speaking, this has been a great company, and is currently undervalued according to price to AFFO. Normally is 20.9, and right now it's 18.7, so it looks like it's a good value. We're looking at the dividend. They've been increasing their dividend for quite a many years, 7 years, and they have a 3.84% yield. Their 3-year and 5-year compound annual growth of the dividends has been almost 10% and 12.5%. Payout is 71%, and their yield is currently well above the 5-year average, so again, it looks like it's a good value. Looking at their financials is exactly what we hope to see. AFFO up and to the right, AFFO per share up and to the right, debt to assets going down, which is a good thing, interest coverage ratio is good, and they have a 95% occupancy. Now remember, these are individual single-family homes, so to get 95% occupancy on that many different units is quite impressive. Their average rent is $24.34 a month, so as I said at the beginning, on the higher end of the rental scale. All right, moving on to our next company, it's Lamar Advertising, and the thing they're mostly known for is the billboard company. So I'm sure you've seen them on the interstates around the United States with their advertisement. That's mainly what they're known for, but they also do other things like buses, shelters, benches, logos, and airport terminal advertisements. They really do have a little bit of everything. I have a 93 out of 100 from all REITs. Their debt is the one area that they felt like it wasn't top quality. They've been around for 29 years, though, so that's good. The price to FFO is a little on the higher side. It's 15.4 compared to their normal at 14.2. So maybe right now is not the best time to buy, but it's a great company. They've been paying dividends for 12 years, and they're currently at almost a 5% yield. Looking at their dividend growth, looking at a 9.7 forward dividend growth rate with a 7.6 and 16.4 historical average. Payout ratio is a little on the high end at 75, but not too bad for a REIT. Looking at their current yield is about fair value, as right along the lines of their 5-year average. And their financials, generally speaking, are good. The only thing, again, is that debt to asset ratio. All REITs felt is a little on the high side, but their interest coverage ratio is 6.4 times. So they have plenty of cash coming in to cover the debt. Next up, we have Mid-America. Now, this is a apartment complex REIT. So they develop things in the Southeast, Southwest, and Mid-Atlantic regions. They get a 90 out of 100 from all REITs. The things that are concerned is the AFFO growth. So scrolling down a little bit more, so it looks like the current price to FFO is 18.3, which is right in line with their 5-year average. The yield is 4.25%, and their dividend growth rate expected forward is pretty low, but over the last 3 years and 5 years is around that 9% mark. 77% payout ratio, and the current yield is much higher than their 5-year average, so again, this looks like it might be a good value. Looking at some of the financials, the last couple of years it's been a little slow when it comes to AFFO growth, but otherwise it looks pretty solid across the board. Moving on, we're at Prologis, and Prologis does logistics facilities, so mostly industrial warehouses and things like that, which has really benefited from the online shopping and everything that goes along with that, but it gets 100 out of 100 from all REITs, so looking really good. The current price to FFO is much less than their 5-year average. It comes in at 18.7 compared to 21.8. Gives you a 3.62% yield, and the dividend growth is steady at expected 5% going forward, but historically it's been 8 and 12% over the 3 years and 5 years. Payout ratio is good at 68%, and the yield is higher than the 5-year average, so again, it's looking undervalued. All the financial metrics look really good. Again, that's why they get the 100% score. Okay. Moving on to the next one is Sun Properties, and this one is a manufactured home real estate company. So you would think that it wouldn't be a very good business, but actually they've done really well, and they've been around for 31 years. So right now they do manufactured homes, but they also have a RV, and they just recently sold off their marinas. So they get a 95 out of 100. Core FFO to share growth is what's causing them to come back. Valuation looks like it's right in line when it comes to price to FFO. Gives you a 3.3% yield. Looks like their forward dividend growth is about 10%, which is really good, and it's higher than their 5-year and 3-year average. The current yield is higher than their 5-year yield, so it looks like it's a good value. And most of the financials look very strong. Again, over the last couple of years, it's been a little slow, but again, that's expected with the way the market's been for real estate companies. All right, last but not least, for the individual REIT companies, we have VICI Properties. I know it's a very popular one in the dividend space. They own a lot of the real estate in Las Vegas, as well as some other places out of the country. So they were created about 7 years ago, but they have 28 gaming facilities and over 47 million square feet of facilities. So the only thing holding them back is a year since IPO, which they can't really do anything about. Price to FFO is in line with the 5-year average at 14.5. They give you 5.2 yield right now. And their 5-year dividend growth rate is 4.8, and 3 years is 5%, so I'd expect something similar going forward. The payout ratio is 74.9%, And the valuation, when it comes to yield, looks like it's right on track. Looking at their financials, looking really good overall. The only thing is the largest tenant is Caesar's Palace. Again, they do a lot of gaming real estate, but these are long-term leases, so that there's very little chance of them having any kind of delinquency or defaults on their rents. Okay, so that covers the 12 REITs that I'm using going forward to the end of 2025 as well as 2026. And the last thing I want to talk to you about was the REIT ETF that I'm using. Now it's IYRI, the NEOS Real Estate High Income ETF. And I've done a couple of videos on this particular fund in the past. I'll link to one of them here. But as you guys know, I'm a big fan of NEOS. So what this one does is invest in real estate ETFs, and then they do a covered call strategy on that ETF to bring in some monthly income. So if you look, it just started earlier in 2025. I bought it right at the beginning. So it gives you exposure to the real estate through US listed REITs, and then they do a options contract strategy on the real estate index to give you that monthly cash flow. Now looking at EOS, it's looking at about 11% annual distribution, and it is paid out monthly. One thing I like about this particular ETF compared to another REIT ETF is the tax strategy. Now they can't do the Section 1256 exchanges, but what they can do is tax loss harvesting within their portfolio with the options that they write to reduce your tax basis. So that's another reason I really like this particular company, everything they've been doing. This is a real estate ETF that I chose to go with. Okay, so that covers all the REITs in my portfolio. Going over them again, it's Realty, Alexandria, it's American Tower, Apple Hospitality, EastGroup Properties, Equinix, Invitation Homes, Lamar Advertising, Mid-America, Prologis, Sun Communities, VICI Properties, and as well as the NEOS product, IYRI. Again, this is not financial advice. This is just what I'm using for my own portfolio. Make sure you do your own due diligence. And if you like the All REITs platform, as I said, I do have an affiliate link. I'll link it down below. I found it to be a really useful tool, and I would love to see what everyone else thinks of it. Until next time, thank you so much. Thanks for watching. While you're here, check out this next video to learn more about dividends, income investing, and option selling. And while you're here, make sure you subscribe. Click the like button. It really does help. Thanks.